Thank you so much. Thanks everyone for being here. Great to see you. And I've really enjoyed the discussions so far. Super insightful, and they've actually set the scene very well for our discussion right now. Please bear with us before lunch. I know you might be hungry. I am hungry for knowledge about transition finance, so I hope you can enjoy this session with me. Now, in the previous session, I think the speakers did a great job, very insightfully setting the scene in terms of what is fundamentally needed for transition. Policies to promote transition, carrots and sticks, as well as transition plans at the corporate level. Now at ICMA, we've actually issued guidance on transition plans at the issuer level. One very important part of that, among others, is to have measurable, tangible capital expenditure plans and operational expenditure plans. So the next step is implementing those plans, and to do that, you need capital, you need investment, you need money. That's what this panel is going to be about. Product solutions to finance transition plans that exist already. So let's get practical and start with the real economy perspective. So my initial question is for all of the experts on our panel who all serve the real economy. When companies ask you, how do I finance the transition? How do I implement my plan? What do you tell them? What are the options? And among those options, what is working and what's not working so well today? Nneka, I'll start with you.
Hi, everyone, and thanks for the question, Mushtaq. So I think the first question we would ask as a rating agency would be, what do you mean when you say transition? So it's a term that's floating around. The things we would look at, first of all, is does the company have a plan to reduce its carbon emissions in a way that is material and represents a significant scope of their actual business. So sometimes we do see companies who have a sustainable financing plan that doesn't cover a significant scope of their emissions or not the scopes that are material to their core business. We would also be asking whether or not there is an actual pathway towards decarbonization or net zero in that particular sector. So assuming we've gotten those things out of the way, being part of the Fitch group and primarily focused on debt financing, then you can start to think about what instruments and financing solutions are available. In the bond market, we have obviously the labeled bonds, green, sustainability, and sustainability linked, and we have similar labels within the loan space. There was actually some research that was put out by ICMA actually that was talking about the share of green bonds that have been issued from entities in hard-to-abate sectors. And actually only around 3% of green bonds in the market are being issued from entities in these sectors. But when you look at the sustainability-linked label, which is a bond that is based on delivery of KPIs and targets, that's about 20%. So what that's really telling us is that the sustainability-linked label in the bond market is probably more suitable for financing hard-to-abate transition. The challenge is that possibly due to macro conditions, possibly due to other factors, sustainability-linked bond issuance has significantly declined every single year since 2021. So what that means is the bond market may not exactly be addressing the parts of transition that are most important for decarbonizing our economy in path with 2050 targets. If you look at the loan market, on the other hand, sustainability-linked loans are actually the most common label in the loan market ahead of the green loan. And that's where you see a lot more activity happening for hard-to-abate sectors. But there are some questions around ambition of sustainability-linked loans. I would say from some of the things we've seen in the market, there could be more ambition on the actual pricing mechanism associated with achieving the targets to make the penalties more material to companies if they actually fail to meet them. And we can also think about whether or not the targets are less ambitious in a loan, which is bilateral or perhaps as a small syndicate of banks and private, compared to a bond where all of the targets and failure to meet those targets are extremely public. So I think we do have a number of solutions, but I think there may need to be a little bit of a recalibration to direct entities towards the most suitable financing needs based on market conditions and also their own pathway towards transition.
Okay, thank you very much, Nneka. Great start to the conversation. And I'll move now to Olivier from the corporate and investment banking perspective.
Yes, thank you, Mushtaq. As mentioned by Nneka, I mean, data is key. ambitions are key. And I mean, you all know that probably all companies in the world are now net zero, which is fantastic from a marketing standpoint, but it's largely marketing, and hence why you've heard a lot of transition plans from all our speakers today. So having a trajectory is essential. Having a trajectory which is Paris aligned will help you, will help us, and will help the company finance its transition by using instruments, as mentioned by Nneka, which are sustainability-linked loans or bonds. But green is also transition. If you take any issuer, be it in the hard-to-abate sectors or in more green sectors, any green additional assets which is being financed is helping transition. So we shouldn't put green on one side and sustainability linked on the other side. Transition is more a thematic, and both instruments, use of proceed and general corporate purpose instruments, are here to finance the transition. What is important again is the measurement of that transition and making sure that trajectories are aligned and that the right data are being provided by the company. So when we start engaging with clients and advising them on the topic of transition, we have a lot of discussions around the data that they have, the historical data they have, and what are the plans they have for the future, and how did they set their targets, be it 2025, 2030, 2035, on the way to 2050.
Yeah, thank you very much, Olivier. And I think that's an excellent point about data, a very important part of transition. And we'll get to that later in the conversation when we talk about impact reporting as well. And Tessa, from your perspective as well, you're based in Sydney, so maybe there's some differences, maybe it's the same. Give us your perspective on some of the practical solution structures that you're talking to clients about today.
Sure, thanks Mushtaq. It's great to be here. So I think to Nneka's point, I mean, there's different sustainable finance products obviously available to help support financing a company's transition. Of course, we can use the products that are established in the market, the sustainability-linked loans and bonds. We can use green in certain instances as well. But it really does come back to really deeply understanding a client's trajectory and pathway. So, you know, all of the panels today have spoken about what a credible transition plan is, so I won't reiterate too much there. But I often get asked why the lack of take-up of an actual transition label. Why are people so cautious to actually adopt and say, I'm doing a transition loan? So to Mushtaq's point earlier, there has been a number of frameworks provided in the market. Climate Bonds Initiative has put out some guidance. ICMA has some guidance. So I think we really shouldn't be too hesitant to actually adopt the label and really shine a light on these transactions. Of course, that comes with needing to substantiate that as well. And so I think it is about potentially leaning into some of these areas. I know there's a debate going on at the moment of whether a transition loan, official transition loan label should be established in the market. And so I think, you know, the labeled deals can help to funnel capital in the right direction. They're not everything though. So I know we'll talk about some of the other areas as well, but it's a starting point, or it's an option available.
That's right. And I'll say a couple of words about the transition label or transition bonds, what that might mean, and what ICMA has been thinking about that, which has been evolving, by the way. But first, I'd like to hand the floor to Tracy as well to give your thoughts on this initial question.
Thanks, Mushtaq, and Dr. Ma, and distinguished guests, ladies and gentlemen. Welcome, and thank you for joining to the 7th Hong Kong Green Finance Forum. And I still remember the first inaugural launch of GFA at the Hong Kong Stock Exchange back in 2018. Coming back to how the market has moved on since 2018 in the sustainable finance development. So coming back to your questions on how as a bank we help company in their to finance their transitions. So I think first questions when I'm being approached to ask that questions, I will ask, what do you mean? What do you mean by transition finance? Do you mean, strictly speaking, transition finance label transactions, or you need financing to help your business to transition to net zero? Because they're very different. Because the latter, you actually can apply across thematic and products to do that. And secondly, I will ask, what do you need the money for? Is it for supporting a particular project or activity, or working capital? Then I will look at, where are they in their transition journeys, and do they have a credible transition plan, like the earlier panel that we share from the panel speaker, or they have ambitious sustainability targets. So from there, then we'll look at, okay, then we kind of advise them on what kind of products and what thematic would work. And if the products is not available, then we'll work with the client to structure something new, which is the fun part. I think I'm very proud at my firm, at Standard Chartered, we are equipped with over 40-something sustainable finance products offerings across thematic. So launching transition finance framework back in 2021 and the adaptation resilient framework this year. So we are kind of pushing the new agendas in the boundary to support. But coming back to also your questions on what work well as well, I think Olivier's and Nneka mentions about sustainability linked loans. I think I'm a fan of SLL because it's more transparent about linking to the decarbonization target. So, and to tie that outcome to the terms of the loans. And then what's not working so well, I think going back to, it goes back to also on, earlier this morning, we heard about the transition finance standard. So this is still very early stage and not we don't have a common standard. So I think from that perspective, more work needs to be done to having a more commonly recognized interoperable transition finance taxonomy.
Okay, thank you, Tracy. I actually have to admit, I really like the way you reframed the question. There's no one product. If you're trying to fund transition, that's a very broad kind of question to ask. First thing to ask is, what are you trying to fund? What kind of project or what kind of operating expenses? And then that can help determine the kind of financing solution for it. So I appreciate that. Let me just make a quick remark about ICMA's approach to transition, because it's come up in the answers so far. So traditionally meaning the last 4 years, ICMA's guidance on transition has been thematic and has been at the issuer at the corporate level. So the way that ICMA, when I say ICMA, I don't mean myself and my colleagues, I mean the larger community of 400 institutional stakeholders in the global sustainable finance community. And we try to generate the consensus of that, right? So the guidance that has come out from ICMA is focused on the issuer-wide transition pathway. That's how we look at transition, not as a particular product, but more as a journey, as a plan, as a way to move from point A to point B. Now, over the last 3 or 4 years, there has been more and more emphasis on transition. I think it's gone from a concept that wasn't entirely trusted and that was a bit niche to one that is very much mainstream and very not expected, but very accepted in a large part of the community, though not maybe from everybody. And the debate has been getting louder and louder, I would say, about the need for a possible transition label. And we're already seeing this in certain countries, right? We're seeing transition bonds that are being issued, generally at the national level based on national taxonomies. So the question is, should there be a transition bond label, for example, at the global level? Now, the answer right now is no. That could change. But the reason for that is that it's very difficult at this point to get international consensus on what we mean by transition. So I think there are 2 aspects to that. One is, how do you even design a transition label? And to Tracy's point, are you talking about project by project? Are you talking about an activity? Are you talking about operating? Right? That's a very fundamental question where there's not consensus globally. And then the second part, which I think is maybe a segue to the next question, or to the maybe question after that, is how do you get agreement on what is valid transition? And the thinking on that varies a lot, not just by country to country. It's not a geographical Europe versus Asia versus US question. It really varies among asset managers, among different banks who take different approaches. So we may see this changing, but right now I don't think we're quite there in order to have a global standard. One thing though, I would just go a little bit off script. I would like to mention a couple of new sets of guidance from ICMA. One is the green enabling concept. So this is, in a sense, a compromise. It's a way of categorizing certain use of proceeds as valid for green bonds, even though they are not specifically themselves green, but can help enable green investment or decarbonization. So I'd like to open it up to the panel if anyone has any familiarity and would like to comment on that.
I'll jump in.
Sure.
I was very excited about the green enabling guidance and have been talking about it nonstop.
Music to my ears.
Yeah, everybody's sick of hearing me at Sustainable Fitch talking about it. I'm actually chairing a working group, so we're going to be coming out soon with our methodology on how exactly we're going to be assessing those within our framework. But if we talk again about the numbers from the ICMA report, about 3% of the green bond market is from hard to abate sectors. We did some analysis, and from the sectors that are most likely to be considered green enabling, they're only 5% of the total green bond market. So obviously this is possibly opening up a very, very new section of the world in terms of the real economy to be able to finance under a green label. I think in our part of the world, based on the types of queries we get, one of the areas that may be kind of most interest is critical minerals extraction, specifically minerals that are essential for renewable energy, batteries, and things like that. So that might be sort of one of the first sectors that we see stepping into the green enabling label.
Okay, fantastic. Please.
Yeah, no, I was just going to add, in terms of funds, firstly, thank you for having me. I didn't get a chance to say that before. With the funds that we're looking at, and you see the transition-labeled funds, the growth in that space has been exponential. So I would say that almost 70% of what belongs under climate funds and has now been labeled a transition fund, lack of global alignment on what that might mean, that 70% of them happen to be transition funds. And of that, I'd say in the last 4 years, there's been possibly 100 funds and $50 billion or thereabouts that's gone into that space. So again, very broad, because it is a broad topic, and until there is consensus, you're going to see, I guess, a lot of different buckets, sub-buckets within that space. The other thing I wanted to mention is you've got, we've been tracking some of those funds to see how they're doing. And so in 2023, you had more than 50% of them that actually performed well, which was a surprise. Nobody expected to see that. So I looked up the data myself, so that's something I wanted to just throw in there before you go on to your next question.
Well, actually, that's a great segue to my next question. And I wanted to dig in a little bit more there, because we've talked about I suppose the supply side, let's put it that way, corporates that are deploying the funding to transition. But we also have to talk about the demand side for products, right? So from the investor community. So I actually want to dig in a little bit more. I think I'm curious, and I imagine the audience is curious. How do you actually structure, define the assets that would go into a transition labeled fund? Again, the way ICMA works is we don't invent these things from whole cloth. We come up, we look at what's happening in the market, we look at the innovations, and the consensus kind of best innovations rise to the top, so to speak. So in terms of how you define a transition fund or a bucket or an investment strategy, what goes in, what comes out, how do you manage that?
That's a question we've been working on for quite a while. So I'll
I imagine so.
From, we looked at creating an index that would be able to help with transition to low carbon, and that was in 2014. So a whole suite of indexes which were low carbon transition. And then in 2020, we had the Paris-aligned indexes that we launched again. Both of those are fairly prescriptive in that it calls for decarbonization by a certain date or a certain temperature. And so they work on a different principle. So then... Are
these by corporate? Are they equity indices? Or?
Equity indexes.
Okay.
And I'll come to one in a moment. And then we've got the most latest one in 2022, which was climate action suite of indexes. And that was really purely a transition tool. And what that did was, it may not sort of cover all of the aspects, but what we did try to do is make it inclusive. And that means it includes hard-to-abate sectors, includes fossil fuels, just about any sector you can think of. And then it looks at the top 50% of those that are performing really well on metrics that are climate-related. And so you start with not excluding. We have to include the sectors. I think Elaine mentioned that earlier. We're not just looking at green, we're looking at brown. And how do we look at aiding those to go down the transition path? And so the idea was to encourage them to do more, if you like, quarter by quarter, which we're tracking. And so they get kicked out if they don't perform on a regular basis. It's not like they're there for life. And I think that sort of forces them to change behavior and stay top of their sector, among their peers. And so that climate action suite of indexes, how it's being used, so asset owners have chosen to take that on as a benchmark. So certainly the Nordics have found that very useful. And then they track their own climate strategies against that benchmark. And then for banks, I think they've looked at it as creating, structured products or derivatives. We've also launched a suite of futures, ETFs that have gone off on the back of that. And so there's a lot of traction because I think it feels like you're not vilifying certain sectors, and you're allowing them to find their path towards decarbonization.
And sorry, I just can't resist because I'm getting a little bit nerdy here, but I do want to know, when you look at the transition pathways that you are requiring the companies to adhere to, are those based on your own internal methodologies? Are they based on some global benchmarks? Are they based on taxonomies?
So it's a mix. I mean, we are looking at taxonomies, but we have our own methodology. And so the climate action one, particularly, I would say, is definitely our own methodology, how we've chosen to go about it. And I think we've been very transparent about how that works and what then belongs and what sort of won't qualify. And by that, means we've managed to attract quite a lot of capital that goes through that. I think investors that were previously looking at that transition part and saying, how do I help certain constituents of their portfolio that are in the hard-to-abate sectors, how does that work? I just want to add a couple of words as well on the bond, corporate bond side. So we've got a new suite of indexes again, which is called the Glide Path, Corporate Bond Glide Path. And that is a lot more, I think, tailored towards countries where there isn't an impetus and a very clear pathway or any mandatory requirement to go on transition. So anything outside of the EU, basically. And then what we've also got in there is a way to address, for some of the long-term investors, so if you're looking at insurance companies or pension funds who can't actually just swap in and out, and they have committed, then the glide path allows them to gradually then shift their portfolio to something that has a low carbon element to it. Same sector, potentially same constituent, but the weighting changes when it hits the maturity date. So that's, just wanted to leave you with that.
Okay, very interesting, thank you. And I'm tempted to go and read your methodology because now I'm curious. But let me take a step back. Unfortunately, we don't have time for that in this panel. Take a step back to think about the global investor perspective. And Tessa, I'd like to go to you next because I think you have a unique perspective working for a French bank in the Asia-Pacific region, but based in Sydney. So perhaps you might be well placed to talk about the different kinds of investor perspectives around the world and within the region. How do they differ? How are they looking at transition? How is those perceptions changing?
I don't think we have enough time for that, Mushtaq, but I'll try.
Try your best.
We'd be here all day.
I know that you're a professional.
I
think you can keep it too.
But I think that's the point, is that if we take back a step, I mean, over the last sort of 5-10 years in sustainable finance and responsible investing, we've been trying to put things very neatly, or as best as possible, into buckets. We've been trying to tighten definitions of what is green and what is sustainable and what is social. And then transition, is happening, but we now recognise, not at the pace and scale required. So we start thinking, okay, well, how do we deploy finance into these areas when we've been so focused on very neatly trying to define things for such a long time. It's scary, it's ambiguous, and I think, you know, transition plans at a corporate level help because you're getting everyone, it's the same thing as a corporate sustainability reporting, which is now much more widespread than it was a number of years ago. If we can get everyone disclosing a transition plan with details, taking those longer term targets into shorter term actions, then we have a baseline level of data. We need to sort of step back and not worry too much about putting things neatly into boxes. That's probably the last time I'll say that word. But there are positive signs. So what I see and what we hear, I mean, there's multiple different data points, but is that transition funds and investor flows into transition areas are growing at a high pace. I mean, but again, I in researching for this panel, you know, I saw one statistic which said that transition funds had 2 times the amount of net inflows in Europe as green funds over the last 2 years. But I also saw that only 0.2% of sustainable assets under management by another measure were actually focused on hard to abate sectors. So very conflicting information there. And I think this is why we keep going back to how do we define transition for sectors and geographies, because we are trying to measure it ultimately. But at the same time, I think there's a general understanding that we can restrict the capital flows if we have too narrow definitions. So while the market is striving to have clearer definitions around what is transition and what is not, or what is good enough and what is not good enough, I think and nothing's going to be perfect. And I think it's about navigating that complexity, making room in your portfolios for that complexity and that nuance. And that's the hard part, because as banks, we're signed up to the Net Zero Banking Alliance. As asset owners, there's a Net Zero Asset Owners Alliance. And people want to have a very smooth, very clear downward trajectory of their emissions of their portfolios. Investing in hard to abate sectors and transition doesn't necessarily look smooth. So it's getting beyond that mindset to get comfortable with the lumpy nature of it.
Thanks, Tessa. Tracy, over to you. What are you hearing from investors?
So I want to share a couple of structural points and observation between global and Asia. So I think from what I observed in private equity fund and also credit fund in the recent year, in terms of pricing structures, I think globally we tend to be having incentive and penalty both way. And Asia, a lot of it still one side incentive only, but increasingly in the recent year, we see that in the fund space also applying for both upside downside structure. And then in terms of key development on how the private equity fund and credit funds go in to drive on the transitions, not necessarily transition fund, but then how the fund deploy to drive their underlying portfolio company to transition. So from there, we see that using KPI to tie to that on a stretchy link structure over the time of the fund. And in the recent year, I think this year, there should be launched already, closed, a credit fund purely looking at their scope 3. So all 3 KPI looking at their own deployment of scope 3 and addressing that decarbonization. So I think it's another way of expressing on different structure on driving that transitions without the transition finance labeled that I mentioned earlier.
Well, that's very interesting, and you raised a good point, which I think has come up a lot, which is engagement in Asia. And there's sometimes a bit of a dichotomy, which is maybe a false dichotomy between engagement and divestment, which used to be the way that environmentally responsible investors handled sectors that are maybe hard to abate or they don't like. Olivier, what are your thoughts on this? I mean, what are you hearing from investors on this theme?
A lot have been said already, but just one thought on that very topic. When it comes to an M&A transaction or an IPO transaction, until a few years ago, the ESG DD, the ESG due diligence, was being looked at sometimes, not always. Today, it's a different story. I mean, the green story within the equity story has not only a meaning, but it has a hidden value that equity investors, you being the buyer or the seller, is something that, of course, is essential to the transaction. So this is what has changed over the last 3-5 years, where when investors are buying companies or selling companies, there is a goodwill, there is a green goodwill that you need to value. And if the company is in a hard-to-abate sector, what is the value of the transition story that you could potentially apply to that asset or apply to that entity? So to me, that's the major, I mean, again, it's a different angle, but to me, from an investment banking standpoint, that's the main change that we have seen when we've been advising on IPO or when we've been advising on M&A transactions over the last 2-3 years.
That's a great point, and I've observed this as well. From my perhaps somewhat detached perch at ICMA, I feel when I first was involved in sustainable finance with the Green Bond Principles 10 years ago, gosh, it was really a kind of a niche product. It was a little bit off to the side. It was something that hippies worked on went between eating their granola, and real bankers didn't really mess with that. But now things have changed quite a lot in DCM deals and bond deals. We see, as a matter of course, during roadshows, questions about ESG, questions about climate transition are just part of the general due diligence. Now, if I may just go a little bit off script again, I want to pose a question to all of the panelists. And this was, I think, inspired by Chitra's remark about the performance of transition investment. I'm curious what you're seeing in terms of not only the actual performance of transition investments as opposed to, say, more mainstream or more conventional investments, but also investors' perceptions towards transition. Are they interested in transition because they want to decarbonize the planet, because they believe that transition reduces long-term risks, credit risks, or is it because they think that performance will be better, or is it a combination of all of those three? Happy to open it up to anybody. Please, go ahead.
Maybe. So I think in what we've observed, and I just spoke about our climate action indexes earlier, so obviously we've seen the traction there and how that's been taken up. Also looking at the performance of some of those constituents. So when we've measured the climate action index against, let's say, the parent index, we've seen that the risk and return profile is very, very similar. But if you look at the actual decarbonization that's taking place, 50% of those emissions have come down in those climate action indexes. So firstly, there is enough data to support what's happening there in a positive way. The other thing I just wanted to throw out there, since you were going off script, and maybe I'll go off script a little bit
Please
too,
do. It's fine.
We are now working on a new concept, and essentially what that was sparked by was some European investors who've come to us saying, this is all well and good, we're doing this, following the transition leaders, or at least investing in them. However, we don't find that the transition leaders are necessarily the best financial bet for us to be investing in. So what we did is go on and do some analysis, and we pulled out a new methodology that we're working on, which essentially looks at which countries have a lot of policy pressure and at the same time also technology pressure. And when you see where that happens, you're then examining the companies that are perfectly positioned to make that work for them commercially. And I'll give you an example. So Norway had that perfect confluence of policy and technology pressure when it came to EVs. And you'd imagine that Volkswagen being in the neighborhood would probably, with all of their focus and being a transition leader on EVs, would have captured that market. But actually Tesla was in there first. And they managed to position themselves with the right price, with all of the right attributes, and then got the largest market share, which was a surprise. So I think there were some of these instances where the question was, yes, we can spot the transition leaders by the technical, what we used to look at, green capex, for example. a whole lot of green capex going on there, which is great. Also, the portion of revenue that might be coming from that part of the business. However, the actual business performance, we had to now examine differently. So to put it very bluntly, one of the investors that sort of brought around this type of thinking, it's the next gen, if you like, from climate action, the next step. Their comment was, I need more than a thermometer. I actually need a risk management tool. And so that was sort of the view that they took. So it's still, very focused on transition, but equally focused on getting a return that makes sense within that sector peer group, which is what we've now developed that concept, launching in a few months, I think, but not yet.
Okay, very interesting. Okay, if no one wants to chime in, go ahead.
I'll add something. Just
Sure.
thinking about investors, there are some, and mentioning regulation as well, there are some things that are happening that are going to potentially change how particularly European-based investors view transition. So the new rules on fund naming from ESMA have come out, and all funds that have a green, climate, or sustainability label will have to be aligned to the Paris-aligned benchmarks, which means that any green bonds that are financing purely zero emissions activities like renewable energy, if the issuing entity has more than 50% of revenue coming from fossil fuels, those bonds are no longer going to be eligible to be included in those funds and would have to be in a fund with a transition name. We did some analysis on this and put out a report a few weeks ago that of the sustainable Fitch rated universe, around 10% of green bonds are going to not be eligible to be in green funds anymore under these naming rules. So what that's done is move assets that have been traditionally viewed as being sort of dark green fixed income assets into a transition label, which could potentially mean that the definition of transition from the perspective of investors is going to change from an instrument level transition to an entity level transition. And that might also potentially open up other opportunities for other bonds with different labels or different sub-labels to potentially be included in those as well.
Okay, thank you. I'd like to follow up on that actually, because in Chitra and Nneka, the way you're talking about transition in terms of how do we have an appropriate definition for transition? How do we know whether a company or a bank, for example, a corporate is adequately transition, right? Whether they have the right risk in place, whether they're on the right transition pathway. So it's a matter of looking at whether it's valid, whether it's working or not. But another angle to that, which I think is potentially equally important, is measuring the actual impact of transition investments, of transition finance. How far are you actually getting towards the goals of the Paris Agreement, towards net zero, towards decarbonization? And Nneka, I'm sure you do a lot of work on this in terms of the impact of transition investments and of transition activities. And could you tell us a little bit about where you are today, how that has evolved over the last few years?
Sure. So I think the hunt for a common definition is really what everybody's looking at. I think what's happening in Asia is actually really interesting. So we have originally put out by the ASEAN Economic Community and now picked up as well by Singapore, by Thailand, and also in the draft taxonomy that's been issued by Australia as well, the sort of traffic light approach to transition. And I think that the sort of amber category that's being used for transition is very, very clear and easy to understand. And I think from the conversations that we have from investors, especially investors outside of Asia who haven't really heard about it or weren't familiar with it, in terms of usability and understanding, find it a little bit more straightforward than the EU taxonomy in terms of how transition activities are treated. So I think what's beneficial about that approach is having very, very clear technical screening criteria and benchmarks, emissions intensity thresholds or absolute emissions thresholds. Obviously, those are set on a country-by-country level, and so you'll see Thailand's is much different than Singapore's, for example. Singapore's are much stricter. But that is like a very good way to start in terms of measuring. So with us sitting in APAC for Sustainable Fitch, we have a lot of conversations with our global team, and we're actually trying to socialize that way of viewing transition throughout the rest of the organization, because the EU taxonomy and in North America, there is no taxonomy. Well, Mexico has one, I should say. There's one. They don't have the same approach. And so how do we think about transition within our methodology? How do we think about looking at the impact metrics that come out of it? it really is something that we're trying to see whether or not that's going to work. And so far, the feedback is good. On an entity level, we also have something called a transition assessment that we do at the moment for the energy sector, and we'll be expanding to mining and metals, where we're really looking at the company on an entity level in terms of their targets, long-term targets, short-term targets, but also the amount of actual investment that they've put, CapEx investment towards green activities, and also the share of revenue that's starting to come from those activities. And so we've had really positive feedback, and that's the energy companies engaging us to do that assessment, which I think is a way for them to kind of have other conversations with their lenders, investors, and other stakeholders to essentially show that they've had an independent assessment of their transition pathway. But I think the challenge is that it's really sector specific. So there's not like a universal definition of what's transition. Transition for the shipping sector is completely different than transition for the steel sector. And so what we try to do is to make sure we have a good understanding of the sectors that we cover and be close enough to the technological developments. But at the moment, it's hard for me to say that for a bank or for an investment firm, there's going to be like a very easy benchmark that can tick off, okay, this is transition. I think there's still going to be a lot of homework that has to be done for quite some time.
Okay, well, with that tough question posed, I'd like to loop in Olivier to try to answer it. And I'm curious how you and your bank are looking at the transition metrics. How do you even make sense of it across your own balance sheet, across all of the businesses you have, corporate banking, investment banking, underwriting, structuring, and what are the most important metrics for you, and how do you reconcile the different sectors, the different geographies in your global business? I know, it's hard.
I have 5 minutes and 53 seconds, but I would
we do have questions from
I'd
the
like
audience,
Tessa
by the way, so please
and
feel
Tracy
free.
to speak as well. Long story short, on our own activity, Natixis has developed back in 2017 a tool that is called the Green Weighting Factor. It was right after Paris Agreement. And that tool is allowing us to track line by line all the financing we have on our balance sheet and to color them from dark green to dark brown. So the tool has been in place since 2019. So since 2019, on a quarterly basis, we see the evolution of the color mix of our portfolio, which is allowing us to see how our own portfolio is transitioning. So that's more internal, but that's extremely useful for us vis-à-vis the regulator, because in a way it's for us a way to analytically adjust our risk-weighted assets to the climate impact of each and every financing that we have in our book. But of course, it helps us as well a lot interacting with clients, because the client is just asking us, what is our color and why? So we dig into the methodology and we explain to them, and how can I improve? So which leads us to discuss transition and have that point and measuring things. And measuring is key. And maybe to your point on green enabling, which is a way to measure transition, we all know scope 1, scope 2, scope 3. That's pretty much well understood by, I guess, the audience. But here, a new acronym, scope 4. Green enabling that you mentioned is extremely important because it allows a number of issuers which do not have any green assets, but that do allow other sectors to be green, to have access to the green loan or the green bond market. And the related measurement of this is called avoided emissions. So a metals and mining company is of course emitting, no doubt, scope 1, scope 2, scope 3. But having said that, if you are producing copper or lithium, at the end of the chain, if you can track that the product is indeed going into a battery, then you are part of that chain, you are allowing the avoidance of emissions. And having that capacity to measure and to provide investors with that measurement is extremely important. So we are a number of banks working on that topic. next to the Green Enabling ICMA working group that we've been co-leading with BNP Paribas, we are working with asset managers in order to find the right measurement of avoided emissions per geography, per technology, which will allow investors to take informed decisions on green enabling projects.
Okay, thank you, Olivier. I'm really sorry, we're almost out of time. We do have some audience questions, and I'm going to pick one of them for our final question. And with apologies to the panelists, I'm going to ask Tracy just to answer this one. So, notwithstanding the growth of labeled bonds, are we focused away from the real issue, which is the gap between the level of capital needed versus the amount mobilized to date? And perhaps you could give a sense of what do you think are the next steps for transition finance? What are the solutions that are emerging, and what are the big challenges that we have to overcome to meet this big goal? You have 2 minutes.
Yeah, okay, 2 minutes, okay. Sure, so I think for transition finance to take scale in the next couple of years, and beyond addressing the definition criteria for transition finance, which we heard from MA and PBOC are working on addressing to expand the taxonomy, I think innovations on financing structure and technology is really essential. So let's take our topic is about transactions, bringing the credible plan to transactions. So let me use aviation example to go through some of the transactions, how you do that. So first of all, technology. So sustainable aviation fuel account for 65% of aviation's decarbonizations by 2050, where sustainable aviation fuel prices nowadays is still 3 to 5 times over traditional jet fuel. So from that perspective, we need technology advancements to bring the price down. And that's where transition financing and come into place. And then on the structure itself, leveraging blended or public-private PPP structure for aviation infrastructure for refilling stations or blended facility to be set up at airports. And this needs collaboration between governments, authorities, and private sector. Last but not least, I think if you guys are here earlier, that we have a presentation on a really new structure on carbon removal projects. So carbon removal accounts for about 20% of the aviation decarbonization pathway. And with this, the transaction that done was a debt financing for funding carbon removal projects, where British Airways, a tech platform, and us as a firm to execute on this innovative structure to optimize the bankability using the tech platform and leveraging insurance to take some of the risk off the transaction so that we can become bankable. So from this across different way of financing structure and technology, this is what we ought to see to move the needles to scale up the transitions in the next few years to come.
Okay, great. So 2 great ideas in there. One is investing in technology, which is another debate entirely for another day. I know there are different views, but also creativity and structuring financing solutions, which is very interesting. And again, another topic for another day. Well, thank you all very much for your attention and your interest. Thank you very much for the panelists for great insights, and look forward to continuing the conversation over lunch and later today.